I got this question, this email about how the question was, I'm not a um, day trader. I'm a more of an intermediate to long-term trader. When do I know when to buy and when to possibly reduce my position or take profits and sell a position? And that's a pretty big question, right? And so what I wanted to do is just take you through a simple process that I use on the Telshi 12, which has really worked in the favor of the Telshi 12 and those who have participated. It's more of an intermediate look at a stock in the market and how it's performing. And then it's a matter of um, putting process to work on those stocks. And so I'm going to take you through that today. This is my chart setup. It's on Trading Views. It's really easy to set up overall. And here's how I approach it. This is IREN. This is a popular position. We've talked about this when it was back here in the $7 range. We brought to the tribe, and the stock has since taken off. It's a Bitcoin miner who is converting to data center development, and they are just skyrocketing here recently, up at $36.26 today. But here's how I set my charts up. I use three simple moving averages. I use the 15-day moving average. Why the 15-day? It basically is front running the 20-day period moving average, which is used primarily on Wall Street or amongst retail investors, but also it front runs that 20-day period moving average. The yellow line here is my 62-day period moving average. That is a quarter of the trading year. So if there's 252 days in the trading year that the market is trading, that's equities, not crypto or anything like that. I basically split that into a fourth of that, and that's my basically this is my line in the sand. This is if stocks break below this, I reduce my position to 1%. That's how the Telshi 12 is managed. So, and then we have the what we call the Tudor Jones, which is named after Paul Tudor Jones. It's the 200-day moving average because he is famously made a lot of money just using the 200-day moving average as his benchmark of where a stock or a commodity or whatever he's trading is going for a very, very long term. So those are my daily, it's my daily, I said a daily chart. I have the SMA 15, the SMA 62, and the SMA 200-day moving average. I then use the RSI, that's this one here in blue, and then a yellow trend line as well. And I use that for strength. Where is this stock going? Is there strength behind it? Is there momentum behind it? And I use this, and that's simply the way it works is anything below 20, this line here, that's typically oversold. Everything, if to be in a position, a positive from a long-term position, 50 is sort of that cutoff. So when I see a stock break below 50, it tells me that the momentum or the strength of that stock is weakening. So I would want to reduce my position. If not already, I've done that through the triggering of these simple moving averages here. When we're above and in the 70s, I know it's getting frothy. It's getting a little bit overvalued. And when it's up here for a long time, I anticipate at some point it's going to give way and pull back at some point. So in this case, IREN has been in this frothy kind of area since basically since August 25th. So it's up there. It has pulled back back in the first of September, first week in September, and then it's moved higher. So that's strength. I want to see strength in that stock. So I use the RSI, and then I use the MACD. This is a more longer term oscillator. It's slow to move. So when it moves, it usually stays. In this case, as you see in here, it's moving higher. And so when I look at this, I got 1, 2, 3, 4, 5 indicators that I'm using, and I'm just using common sense. If the stock breaks below the 15, I know it some point this thing is weakening. The market, the 15 is front running the 20, so the market's going to digest that as a negative when you get to the 20. So I want to be on top of it. So maybe I tighten my trailing stops, or maybe I reduce my position, especially if I bought it back here. We implemented the Telshi 12 on June 16th. So that would have put you right here at a price tag of $10.40 if you bought it at the end of market on that day. That's a heck of a run. That's 3 times your money plus. So that's pretty strong kind of position to be in. So I'd want to protect my profits. Maybe if it breaks below the 15, I tighten my stops from a 7 to 10% trailing stop to more of a maybe 5, or I just take some profits off the table and wait for it to balance out and move higher. We saw that back here on July 24th, broke down. And then, if you had followed that and reduced your position, say by, from 8% full allocation to say half that, 4%, you would have taken your profits out of that, held 4%. And then when it broke above, you would have bought back in, dollar cost average in as it moved higher. So reducing your position after it breaks below the trade trend line by half could be a way to do it. That's one way of doing it. Other people have other ways. Other people would be like, well, hey, if it drops below this, if I go back here, back in March or February, where it broke below both the trade and the intermediate trend, I reduced my position to a minimum of 1%, and I just ride this out. And then once it starts breaking above, in this case right here, it broke above the intermediate trend line. That's a yield line. You'd start dollar cost averaging back in until you had a full 8% allocation. So that's one way of thinking of it. I watch my oscillators. I watch my MACD, my RSI. But this yellow line, that's the line in the sand to me. Because typically when you break below the 62 period moving average, the momentum has changed. And you can start by looking at like SPX. So if I jump over here to SPX and I look at that, blow this up a little bit here, when you see a breakthrough, SPX is S&P 500. You broke through the trade trend line, the intermediate trend line. At that point, I would have reduced to 1% holding. If I break, to 1% holding once I break below the intermediate. Once I get through the 200, then I'm down to 1% holding. I just ride that out because I still want to be in it. I still believe in the index or stock or whatever. But once I start breaking above the trade trend line, that gives me some positive feelings of the market is rebounding here. And maybe I allocate, 50 basis points or 100 basis points at a time, but I really don't get a massive exposure until I get above that intermediate trend line because it could easily reverse. And I don't want to reverse on me. So I want to have low allocation to it. So once I break through that 62 period moving average, then I know momentum is sort of in my favor. Money flow is flowing towards in my favor. And so I then start dollar cost averaging into my full allocation and I write it up. And if you had done that, you've done pretty well overall. So that is how I look at it from a charting standpoint. Let's review the Telshi 12 and just give you a sort of an overview of it and how it's done so far since inception. So this is the Telshi 12. I send a updated version of this out every morning, Monday through Friday. You can also access it through our website if you're a subscriber, which right now we're only offering one platform. That's the Platinum channel. You get a 14-day free trial if you're interested in taking a look at this and giving it a test run. But this is one of a handful of things that we offer at Best of US Investors. So let's just hit upon this. The idea behind the Telshi 12 is this. Kerry was doing all this research. He has stocks that he is investing in. And the way I look at markets is more from a mathematical quantitative side of things, whereas Kerry's more on the fundamental side of things. So I wanted to take his list, which is up to 60 positions that you could invest in. Some he is investing in, others are on watch list. And so there's, the tell sheet, Kerry's tell sheet, and then there's Kerry's watch list. So what I did was I took those and I ran a model, more of a fractal model on this, something I've been working on for quite a while. And I looked at fundamentals from a mathematical standpoint. Are they growing? Are they declining? Is the sector or in that particular subsector going up or is it going down? I then looked at the market, price, volume, and volatility. And I looked at it from a mathematical standpoint, and I came up with 12 positions. The original portfolio had IBM in it, and on July 28th of this year, we got rid of it. I put this to work as of the close of business on June 16th of 2025. And these are the prices of everything that were at that price, except for AppLovin, which we replaced on July 28th. And I put that price was its price on July 28th. So what this says is if you had equal weighted this, so comes out to about 8% since inception, these are the returns you would have since June 26th, so 67.59%. Now, if I had started this portfolio back on January 1st or January 2nd, whichever the first day of the trading day of 2025 was, you'd be up 85.5%. Possibly even better if you had followed the intermediate and trade trend line example that I shared with you earlier. But if you just bought and held it and then made your switch out from IBM to AppLovin on July 28th, you're doing pretty darn good. Here's the risk of this portfolio, and I'll just be upfront. It's 12 companies. So if you don't have a risk management process in place, you could get it taken out to the woodshed. And that's why this is so important to have your what you're going to buy, how you're going to buy it, or your research on buying fundamentally or technically. But it's also when is enough enough? When is a loss too much? And that's why having a risk management process in place. And that's what my trade and intermediate trend lines are all about. That's what simply looking at, I'm getting more and more into the gamma setup, the market maker gamma setup, and you can find that in the gamma report now that I actually just put out today, September 16th, and I'm expanding that to include the Telshi 12 as well. And I talk about that on the Morning Edge as well. So if you're not a subscriber, you get the Morning Edge at 7:30 Central, 8:30 Eastern every morning, Monday through Friday. We go through the swing trading list, and Mark does that, and I talk about market structure and all this crazy stuff. And then we opened it up to the floor for charts and questions, Q&A, and all that kind of thing. So overall, since inception, June, we had a great month, a rebound month, in my opinion. It was up 27.06 because we had just sold off into April at bottom in April and moved through, market moved up through up into July, and you can see July's numbers, the returns were like 12.57. And then August, we were up 16.48. And so far this month, we're up 16.55. These returns are like blow my mind. Okay. And I have this rule, it's called the 10th man rule. I stole it from the movie World War Z. And in the movie, Brad Pitt asked sort of the ambassador or whoever of Israel, how did you make a decision to wall off Israel after working on walls around Israel for the last, what was it, 1,000 years or something? How did you make that decision and you finished these walls like in a matter of moments? And he explains, he says, 10th man rule, and that is it. 9 of the people on the board agree one way, the 10th man is to take the opposite way. And that's how I look at this. I look at these returns and I go, this is awesome. This is fabulous. People are making money. I'm getting, this is awesome. I'm doing great. But I always ask, why is this not going to work? How can I protect myself? How can I take profits and preserve capital? And that's what all of this is really about. So this is a hypothetical portfolio that I implemented. I applied my quantitative fractal model on this, on Kerry's companies, and then I make changes as I see things break down. And I usually get the tribe to actually give me some input. What do you think? So, for instance, App Lovin was suggested by one of the guys on the call, and I said, well, I want to get rid of IBM. How do I, what do you recommend? What do you guys like? And they said App Lovin, and I ran it through my screen. I was like, boom, great, that's fantastic. Did it, and we bought it right around $370.96, and today it's at $599.60. Not all that bad of a decision, right? So overall, this is the Telshi 12. This is how I run it. When it comes to buying stocks or selling stocks, take a look at how I set up my charts and how I simplify it down to 5 indicators. You can apply that to anything, and you can apply it to a daily or a weekly standpoint as well. So hopefully it gives you great insight to how I think and how you could possibly build a process around these ideas, but make it your process, make it what you feel comfortable with. And by doing so, you'll feel better about investing. You'll understand why you're doing something. But more importantly, you have a tribe with Best of US Investors that you can participate, ask questions, because there is no dumb questions. I ask a lot of dumb questions. My whole goal is to be the dumbest guy in the room asking questions, because that's how I learn. You should do the same. So it's a great community, great place to be. We're offering a 14-day free trial at this point on the Platinum channel. We're topping this out at 1,000 subscribers come October 1st. So once we're at 1,000, we're capping it, closing the door for a while, and we're going in deep with our tribe members and going to just make everybody turn these tools into assets that they can then turn their dreams into reality. And that's what this process is all about. It's about teaching you how to do something, how to make money, so that you can then go implement or make your dreams a reality. Bottom line, what's money worth if you're not using it to grow yourself as a person, spend time, and create memories? So that's it. If you have any questions, you can always email me at support at Best of US Investors, and I'm more than willing to answer those questions. But whatever you do today, whatever you decide to do, and whatever you take from this video, have a process, have a passion for what you're doing, and always be learning. But more importantly, always, always live loud.